inflation relate to retirement? Well, here to talk with me about that very topic is Sean Hanlon, the founder of Hanlon Investment Management and Vestbridge Advisors. Sean, welcome.
Hi, how you doing, Bob?
Great to have you here. So let's start here. When I think about inflation, I think about its impact on those saving for retirement, those on retirement's doorstep, say 5 to 10 years away, and those in retirement. So how does inflation impact each of those groups, and what advice do you have for those groups with respect to their savings, their investment strategy, their drawdown strategy if they're retired, and perhaps even their living expenses?
Yeah, so inflation's been the major topic, right, for some time now. And so the first question for all of those different groups is, how long will inflation last? And certainly people have been in a panic and an uproar about inflation. But recently, the bond market and the future markets have started to indicate that maybe inflation's coming down. For example, just in March, the 1-year forward inflation expectation was 6.3%. And recently it's down to 3%. So maybe we're heading back to the Fed's, 2.5% inflation target.
Yeah. So given that that current state of affairs, how does it affect these three groups of retirees?
Yeah, so the first two groups you mentioned, the one that's saving for long-term retirement has a while, and then the one approaching retirement, I would say that the key there is obviously they need a sound asset allocation strategy. Interest rates have come up some, so the fixed income part of their portfolios giving them a little bit better return. And even with the correction in markets, we've seen valuations get closer to the median long-term valuation. So with a good sound asset allocation program, I would say no major changes for that group.
Right. And for those living in retirement?
Well, the ones living in retirement, they're the ones feeling the most pain recently from inflation. And of course, there we have to counsel them to be prudent from a financial planning standpoint, mainly their expenditures, their current expenses. And if they can be careful and maybe postpone some things. For example, I wouldn't suggest any retiree should run out and buy a house today, right? We just saw some housing news come in where new home sales, which were up around 1 million units, are now down to 500,000 units per year. And the same thing with inventory. Housing inventory was 3-4 months. It's now getting back up to 8, 9, 10 months. Yeah, so those are the types of things that I would pause on. Yeah. But the other side of the coin, of course, Bob, is that if any of their portfolio is indexed to inflation and their income is indexed to inflation, such as Social Security, they're going to be getting a nice surprise here come January from Social Security.
Yeah. So the other topic that's on people's mind is market volatility, stagflation, and of course, rising interest rates, or at least the Fed increasing interest rates. Talk a little bit more about that.
Yeah, so the market volatility is there for sure. We've all felt it. And you would expect that after the incredible monetary and fiscal influence that the government had. And they built a bubble. And, when they take the punch bowl away from the market, the bubble is going to pop. And that brings volatility. So we should expect probably a little more volatility as we head into the fall here, particularly with the Fed ready to raise rates again in September. But with this volatility comes a great opportunity to rebalance your portfolios.
Mm-hmm. So I follow some investment writers who suggest that we're heading for stagflation. Any thoughts about that?
Yeah, so stagflation is when we have inflation, but really no growth or little growth in the economy. And again, measures that we follow are saying that inflation is probably cooling and should come down. And then more importantly, the first half of 2022, where the massive buildup of inventories that occurred late in 2021 and early 2022 is bleeding off. And so we should see a healthier GDP in the second half of 2022. So therefore, we think stagflation is not something that's on our radar.
Well, that's good to hear. So we're talking a few days before Fed Chair Powell will be talking in Wyoming. Any thoughts about what the Fed might be doing with short-term interest rates?
Yeah, well, the play here is it 50 basis points or is it 75 basis points? And I think no matter what, they've got another 75 basis points to go. They've got to get up to that 3.25 on the Fed funds. So whether they do 50 in September and 25 in a following month, or they do it all in September at 75, we'll see. But again, there's so many indicators that says that this inflation pop is behind us and that it's cooling.
All right. So it's hard not to talk about the Fed increasing rates as well as the effect it has on interest rates overall. Talk about what you've seen there.
Yeah, well, here we are in August of 2022, and 24 months ago, we had 10-year treasuries at 60 basis points. And 12 months ago, we had 10-year treasuries around 120, 130 basis points. And now here we are at 3%. So interest rates have doubled over the last 2 years. And we think we're probably at peak interest rate for this cycle. We were at 3.5% in June. We've come down to 3% on the 10-year treasury. And the key is long-term inflation. And long-term inflation, we have to remember that in the last 10 years, certainly up to about 3 years ago, we were fighting deflation, Bob. And that was a real worry because inflation's bad, deflation's horrible. And so with the forces that put deflation in place, namely technology and massive improvements in technology, demographics, the aging population, and then generally high debt around the globe, those are deflationary forces. They have not changed. Those forces take a long time to change. So we think that interest rates probably are seeing peak levels more or less, certainly not notably higher from here.
Yeah. So let's turn our attention to a new development in the world, in the investment world, which is something called direct indexing. Can you explain what it is and how and why investors might incorporate this into their investment plan and its pros and cons in terms of using direct indexing?
Sure, Bob. Yeah, we're excited, very excited about direct indexing. And as its name implies, it's a way to directly own the makeup, the members of an index. So, for example, the S&P 500 is made up of 500 stocks, give or take one or two. And our clients, our investors, can directly own, say, 100 of those 500 stocks and be able to replicate almost with 100% correlation the performance of the S&P 500.
Right. And then in terms of the costs and taxes that are involved with direct indexing?
Yeah, and so the benefits are that by directly investing, you don't have any internal expenses from the ETFs or the mutual funds, so you get rid of those expenses. And then also by directly investing, you can really have a bespoke and a personalized approach to your portfolio management to be able to do tax loss harvesting, to be able to personalize the portfolio and embed ESG preferences, as well as to avoid certain stocks, industry groups, major economic sectors for whatever reason, and generally have hopefully better outcomes because you'll have lower costs and lower taxes. And as you know, Bob, those are two of the main only things, if you will, that we can control, along with a good asset allocation and good investment advice to our clients.
Right. So in terms of investors who might be interested in this sort of thing, obviously, to me, it sounds like there might be some extra time involved in creating such a portfolio, or is that not the case?
It's really not the case. The best way to go about investing in a direct index portfolio is to make sure you do, a good amount of profiling up front of the client, understand their tax situation, their preferences, et cetera. And then in implementing a direct index portfolio, we can do it immediately with the power of technology that we have today with the optimizers. And again, with the commission-free trading that is now available. We don't have to worry about buying 100 stocks for, say, a portfolio that's $500,000 and getting creamed on commissions. The commissions are for free, thankfully.
Right. So, Sean, we've covered a lot of ground. Anything we missed or anything that just bears re-emphasizing before we wrap up?
No, everything's good, Bob. I appreciate the opportunity and the ground we covered. It's great.
All
Great
right.
to see you, Bob.
Well, Sean, thanks ever so much for sharing your knowledge and wisdom with our viewers. It's greatly appreciated.
Thank you, Bob.